This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Today we have with us Chris Urso. He's the managing partner of URS Capital Partners, a private multifamily real estate firm based in Long Island, New York. URS Capital Partners has acquired over $100 million worth of multifamily properties throughout the Midwest and Southeast and services over 150 active investors. Chris has raised over $33 million in private capital for his real estate projects. Real estate has been his true passion since purchasing his first property more than 15 years ago. Chris started out leading a multi-state team to acquire, renovate, and sell over 60 single-family homes. And in 2010, he directed the firm's efforts towards multifamily with the purchase of a vacant 40-unit building and has since taken a very systematic path to acquiring over 1,800 units. What makes Chris's firm different is extreme diligence at the deal level, high level of execution at the property level, and the integration of technology and personal service for an exceptional investor experience. Working mostly with accredited investors, Chris's core focus is value-add deals where, through physical or economic improvements to the property, he can generate and pass that increased value on to his investors. Well, Chris, gosh, what a background and what a story. Thanks for joining us here on the Old Dogs REI Network.
No, thank you so much for having me. I'm very excited to be here.
Well, Chris, I just kind of gave an overview of your background there, but what we'd really be interested in is finding out how you got into real estate investing and eventually into multifamily.
Sure, I'll try to condense it here, the story over the last 15 plus years. But way back when, graduating college back in 2000, and I started working for a buddy of mine's company in New York City. It was a litigation support and document management business, so completely unrelated. Neither myself nor my wife came from a real estate family or real estate background. So literally got the start from a book I'm sure you've heard of, and many of your listeners have, Rich Dad, Poor Dad.
Oh, you bet. Yeah.
Yeah. I mean, a buddy of mine handed me the book at 20 years old and said, here, you got to read this. And I read it on the train as I was commuting into New York City from my parents' house. I was living in their basement right out of college, commuting about an hour and a half each way into the city, and read the book probably 3 or 4 times in a week, and handed it to who was at the time my girlfriend, Lisa, and said, here, you got to read this. It's pretty powerful, And after she read it, we both kind of gravitated immediately towards real estate. And, as the book says, you got to talk to people, find others that have done it. Started talking to people, friends, colleagues, coworkers, anybody that would listen, and said, hey, you know anybody that's in real estate? So my old boss and now great friend and partner at the time, said to me, hey, why don't you talk to Mike, one of the guys from the moving company? I think they're doing some stuff out in Paterson, New Jersey. He's like, I don't know what the hell they're doing. I think they're buying stuff and rented it out to Section 8. That was his description. So I reached out to Mike, and he said, sure, you want to come out and learn, feel free. And Lisa and I would drive out there pretty much every Saturday with a pretty good headache in the morning, at 21 years old, typically out late on a Friday night. But we would wake up and drive out to Paterson about an hour and a half and just kind of tag along. These guys were buying and renovating 2, 3, 4 family properties and renting them out to Section 8. So after 6 months, they came to me and said, hey, you want to buy this place? We were literally standing in a place they were renovating and said, hey, you want to buy it? We'll get it renovated. We'll rent it out for you, and we'll help you out along the way. But you're going to need about $25,000 for the down payment. We can help you get the financing. And I went home. I'll never forget, sat down at my parents' table and said, hey, we got a great opportunity. I'm very fortunate that you guys were going to pay off my student loan, as a graduation gift. And I said, instead of paying off the $25,000 in student loans that I have, why don't you give me the money and I'll make the monthly payment on the student loan every month, and I can use the $25,000 to go put down on the 2-family property. And, my mother started with, what happens if the place burns down? What happens if somebody doesn't pay rent? What happens if somebody slips and falls? And I said, what happens if I get hit by a bus tomorrow? And she said, you know what? This is something you believe in, you want to do, then we're behind you. And we took that $25,000, we bought the 2-family, and at 21 years old, it was the greatest thing in the world. We were making $800 a month of free cash flow, living in my parents' basement, and that's ultimately how we got our start in real estate. And from 2001 to 2006, we continued to dabble. Lisa left her job. She was working at the New York Federal Reserve Bank, just a small little bank here in New York, and was on the path to have a 30-year career there, and left and got her master's in real estate from NYU. And we started buying up more rentals, did some spec houses, got married, moved to Edgewater. And 2007, I'll never forget coming home and telling her, we're selling everything. We'll figure it out, including the place we live in. I think it's time to sell. And the company I was with sold also at that time. And, it was either stay on with the new company and have a 40-year career in litigation support and document management, or push our chips in and get into real estate. And we started the company in 2008 full time.
Wow. That's an amazing story. How did you kind of anticipate that the market was bad, that you had to sell at that time?
So
in 2007.
Yep. 2000. I remember distinctly. By no means am I ever the smartest guy out there. Usually the opposite, but we have a good feel for things. And I'll never forget getting a haircut, and literally the barbers talking to each other, saying and bragging how they're going to make $50,000, flipping a contract on a spec condo in Miami, basically not closing on the deal, just handing the contract off to somebody else for $50,000. And, at that point I went home to Lisa and said, the market's broken. Like, this is like the tech bubble where soccer moms were becoming millionaires because they'd throw a dart at the newspaper and pick a stock because everything was just going up. So there were no fundamentals left in the market. We were fortunate when we started in 2001, it was a horrible real estate market. So we had to buy based on fundamentals. It wasn't just buy something today, sell it tomorrow because it went up in value. And, that's a lesson that we'll never forget. And I think that's what keeps us grounded and very conservative on our deals today.
Wow. How many homes did you have when you sold, or had you moved up to at that point?
Yeah, we had about a half a dozen properties. So anything from single families to condos to our townhouse to a couple of 2 families.
Wow. And gosh, you got definitely at the peak of the market. So after that happened, you obviously had some cash here, and were you tempted to go right back in and start investing again? What was happening 2008 through 2010?
Sure. So 2008 is when, mid 2007 to mid 2008 was kind of the transition period where I left my old job. We moved, kind of got situated, started the company mid '08, right around when Bear Stearns collapsed. And, another moment where I get the call from mom, like, you sure you know what you're doing here? The world's imploding and, you just quit your job. And, by no means did we know how bad it was going to be. But we kind of stuck to what we knew, which was residential property, 1 to 4 families, but we had a finite amount of cash. So we couldn't really play here in New York because we just didn't have the cash to keep moving. So that's what led us to these markets, like Cincinnati at the time, to kind of find a bread and butter market, lower barriers to entry, but a little bit more of a steady horse too. Cincinnati didn't go through massive appreciation like other parts of the country did. It went up more than normal, but kind of chugged along. And we were able to then set up shop with some good local contacts, and we started buying and renovating, these $15,000, $20,000 houses. We'd buy them, renovate them, rent them out, flip them, wholesale them, whatever we could do to be moving and recycling money from 2008 to about late 2009. And we did about 60 houses during that time period.
And what prompted you to get into multifamily from there?
I think the biggest thing was really after doing that many transactions at that price point, and the amount of work that was involved on each and every deal to try to eke out, whether it was a couple of $100 a month of cash flow from a rental or, there's only so much upside you can get on a $80,000 house. You're not going to make $50,000 of profit. You're doing all this work to make $10,000 or $11,000, $12,000 of profit. And we just kind of looked at each other and said, there's no scalability. So we went out and we got a coach, kind of a mentor, business coach, life coach, psychiatrist, all rolled in one. By far, the gentleman had the biggest impact on my professional career out of anybody during that time. And, he said, what's your goals? And I said, I want to build a $100 million real estate investment business. And he said, okay, take out a pen and paper. And he said, if you figure your average home price of the deals you're doing now is $50,000, he goes, you need to do 2,000 houses to basically get to a $100 million business. And that's when I almost fell out of my chair. And he said, exactly, if you want to grow this business and you want to get to that scale, you got to play up. You got to play a bigger game. He said, it's no different. It's all the same principles, but now instead of buying 1 and 2 families, you got to direct all your attention, get rid of the kind of gnats and, the time sucks of these smaller deals and focus on bigger deals. And that's when we made that transition. December 27th, 2009 is when we bought our first 40-unit building.
Wow. And then from there, it was all multifamily after that?
That's it. I mean, we had some cleanup, make no mistake, of the single-family space.
Oh, I bet. Man.
To kind of wind down out of during 2010. But after that, it's, my wife catches me looking at something else when she walks in my office, and it's just delete it immediately. Not even a question.
Right. Did you lose on that, selling the homes that you had?
Yeah, I mean, we definitely lost some money. We did well for the most part, and I'll tell you, I mean, we took some licks along the way, without a doubt. One thing I learned is to never buy a 4-bedroom single-family house that you're going to rent out to a Section 8 resident. It seems great on paper, like, hey, you can get max rents from Section 8, but the second that first turn comes, when somebody moves out and you realize that you got to replace all the carpet, paint 4 bedrooms, dining rooms, living rooms, kitchens, bathrooms, it sucked up, your entire cash flow. But we took some good hits, but I will tell you, I'll never forget the last one we sold. We bought it for like $15,000. We put 20 in. We were into it for like $35,000. We were trying to sell it with 0% no money down, 0% seller financing. And we couldn't even give the house away. I think we sold it for like $9,000. And my wife and I went out to our most expensive favorite Italian restaurant that night. We're done with that phase of our life. And it's time to really just be 100% focused.
Right. Oh, wow. What a neat story. Now, you just sell the 40 unit today?
No, we sold that. We bought that 2010, about 2014.
Okay. Wow. Now, making that move to obviously go after multifamily apartment buildings, that is a very different area. I mean, you can almost do the single family thing all on your own without having to involve investors in many cases, but it's kind of difficult to do multifamily with investors. When did you have to start to pull in other money, outside money, to do these deals?
Sure. So the first round of houses we pretty much did it on our own with a partner, and then for the second round is where we kind of got our feet wet, where we put together some friends and family. We raised about $500,000, so we did a pool of homes with them. And then for the first multifamily, everything was all cash still back then. In 2009 and 10, there really was no financing. Mm-hmm. So our first three multifamily deals we raised $450,000, $780,000, and $1.3 million, respectively, all 100% cash purchases and renovations.
Unbelievable! Wow.
It's from friends and family, and that side of the business we put so much pride in and so much weight on because we knew that it was going to be an integral part of our future. I mean, I studied every possible offering that I can get my hands on from guys that were raising 20, 30, 40, $50 million and tried to emulate and replicate what they were doing just on a much smaller scale. We always took the approach of, if we're doing a $500,000 deal, act as if it's a $5 million deal. Treat your investors that way, report to them that way. The professionalism, the presentation, the communication just elevated tremendously each step of the way. And I think that's really allowed us to kind of build our investor base to the levels that we have today and where we want to go in the future.
In doing that, now, did you ever develop like an outside fund, or was it always just raising money for specific projects?
Yeah, so we're still on the deal by deal basis in the business. I think we're getting to a point probably, I'd say within the next few years that we'd be at a point to really entertain a fund. Comes with different pros and cons, but we still do all of our deals on a deal-by-deal basis.
Now, did you initially, when you started out, think you were going to hold on to these buildings, for until you retired, or did you have a sort of a shorter exit plan in mind?
So what I learned from a couple other mentors in the business is it's a different hat you have to wear when you're running an investment business versus being a private real estate investor, right? So you or I could, shake hands tomorrow and say, let's go buy this building. We're long-term, we're comfortable, let's hold it for 20 years and, build a tremendous amount of wealth on it over time. When you're in the investment business and, you're basically serving private investors that all have various needs and wants, and reasons for investing in your projects, that you have to drive returns for them. And to build your business, you have to show performance. And really, no matter how good you're doing operating a deal, your true performance test comes when you're able to take a deal full cycle, meaning, buy it, operate it, and sell it, and return investors' capital with their profits to be able to scale. So we do look at all of our deals for the most part on anywhere from a 3 to 7 year timeline. Some instances will go out a little bit longer than that if we have a small group of investors that are very particular on saying, hey, we're very comfortable going out 10, 15 years on a project.
So they're just happy with the percentage return they're getting on a quarterly basis, and for the most part, right? Yeah.
But I'd say in bulk, we really try to look at our deals on, again, a 5 to 7 year horizon, because investors, they're not necessarily super comfortable tying up capital either. If we presented a business plan that was a 20 year hold, I don't know how well received it would be from our network.
Right. No, I understand. Yeah, you can't tell where the market's going to be in
Yep.
another, a couple of years. Plus, it's also nice to get that little equity, boost at the end too. What kind of rate, if you don't mind me asking, are investors generally getting in your projects?
Sure. So we've sold since we bought our first multifamily deal, we've sold 6 of our projects already. And I
Mm-hmm.
think we're up to our 14th acquisition. Um, and we've done on average, our targets look to generate like a 7 to 10% cash yield, meaning during the hold period once we're stabilized.
Mm-hmm.
And then on a deal level, we're trying to net our investors out, 100% return of capital with a 15% plus annualized return, and over the life cycle of the deal.
Oh, that's nice. That's
Yeah,
nice. Yeah.
and we've done, we've hit right spot on that. Been right around the 14 range to as high as 55%. On some deals that we've killed it on, but we really kind of set the expectation, when you see our underwriting, between that, call it, mid to high teens net investor return over the life cycle of the deal.
Right. Right. Well, that's great.
Cash flow and profits. Yeah.
That's a nice target, and yeah, definitely sounds like you're getting some nice returns there for your investors. That's great. Well, getting involved in this is also, it was very new for you. I think a lot of people, buying a house is so much easier. Most of us have done it, for personal, our personal use. So it's not a big deal. But getting into a multifamily, there are other elements that you have to be aware of, and to do that kind of deal. And if you get into syndication, it gets even more complicated. What would you say, so far? What would you look at as sort of your biggest mistake in the life of your real estate investing?
So I think I'd say my biggest mistake kind of dovetails off of what you just said, was basically starting too small.
Mm-hmm.
When I went into this full time. And I had this conversation, most of our investors are probably very similar to your listeners, but I would say starting too small. If I knew then what I know now, I missed the probably greatest buying opportunity of the near future. I don't want to say of my lifetime, but 2008, 9, and 10. If I was purely buying multifamily, we'd be having a much different conversation right now. Not that this isn't a great one. We'd be having an unbelievable conversation. So I think sticking to what I was comfortable with at the time is probably our biggest mistake. And it was kind of like the definition of insanity, right? For 2 years, I kept doing the same thing and same thing. Buy more houses, buy more houses, buy more houses. I thought that was going to be the catalyst, but we were in the wrong strategy.
Right.
And I have this conversation with a lot of our investors, because they'll come to us and say, okay, I have $500,000 that I want to allocate to real estate, but, I really want to do something on my own. I can go buy these 5 houses or 10 houses or 1 house, which is even worse. And I have that conversation with them, and I say to them, I can say this because I did it. I'm not trying to convince you to invest with me. I'm trying to just open your eyes up a little bit, that you can take those dollars and go buy $10,000, $50,000 houses, which are going to be great, but what are they really going to do for you over the long run? And what type of economies of scale are you getting from that investment, which is really none at the end of the day. And that $50,000 house typically is going to be worth $50,000 or less 5 years from now, because of the type of product that it is. Those homes are in primarily rental neighborhoods. They're lower end. It's easy to do. You can click a button and buy a house today. But if you can take that $500,000 and diversify it across 5 multifamily deals, as a passive investor, I get it. You're not 100% active. You're not 100% in charge, but do your diligence on the sponsors that are offering these, and align yourself with somebody that's done this already and is also going to give you the benefit to kind of leverage your dollars to be part of a bigger game versus playing too small. I don't know if that makes sense or not, but
that makes all the sense in the world. As those of us that have looked at multifamily and really seen that there is no comparison between buying single family homes and multifamily. I mean, I kind of saw it myself just going from single family homes and some duplexes. I paid pretty much the same for the duplexes that I did for the single family homes. But, the difference was real obvious in that I only had one property tax payment with the duplex. I only had one insurance payment. I only had one roof to repair. The economies of scale, even on the smallest level like that, you start to see, gee, why am I buying single family, period? And obviously, when I get into bigger 22 unit out in Indianapolis, I'm just seeing, wow, what a difference does it make? I mean, it's just unbelievable. The same amount of work, just going into it and buying it and acquiring it and getting it funded and all that. But man, what a difference in terms of return and just the lack of having to deal with all these 22 houses. I think I'd be going crazy right now.
22 tax bills, 22 insurance bills, 22 water bills.
God.
And if they're not in the same, same area, then you're dealing with different management companies. It's, don't be too proud, to say like, I want to own something 100% on my own just for the sake of owning it on your own. It might not be the best thing that's in line for what you're looking to accomplish with those dollars.
Right. My big thing is that, as I've done this show, which has been a blast, I've met all kinds of people, and some of them, their first property they purchased, was over 100 units. Their first property. And I'm going, I should have done that. I should have never messed with the 22 unit. I get it. I can understand. You really can, go for the gusto on this and do it right. I think you definitely need the mentoring and the coaching. That's really critical. But it's doable, and it really is. At least the places I've seen around the country, there's some great deals out there, and it can be, especially if you're not afraid to do out of state investing.
Yep, absolutely.
So your biggest mistake, you would say, is obviously not doing it sooner, not getting involved sooner. What would you look at in terms of your biggest success?
I think our biggest success to date was basically making the jump from, we had done our first 4 deals were 40 units, 23 units, 37 units, 100 units. Those were our first 4 deals.
Wow. We
went from that to an extremely heavy lift, 280 unit value add. I mean, heavy lift down in Charleston, South Carolina. We had spent about a year or so understanding the market, and an opportunity came up. And it was, the stars aligned. We knew the market really well. We believed in where it was going. And this 280 unit property, if you would have told me a year before we bought this deal that we were going to own it, I would have said, you're absolutely crazy. There's no way we would ever own this deal. And we got aggressive with it, and we got all of our ducks in a row. We were 100% focused on it, and we bought a 280 unit, highly distressed property, sub 80% occupancy, tremendous amount of deferred maintenance, drug activity, criminal activity, get 25 down units that were unrentable, dilapidated. It was basically the property that if you, as a tenant, were told no from everywhere else in the area and you needed a place to live, you would go there because they would take you. So you can get a sense of the situation on that particular property. And we bought it in 2013. In August, and we invested about $2 million of capital into it very, very aggressively and intensely, and brought in new management, new team. We were on this deal every day, basically for 3 years straight, driving the turnaround. And we turned over pretty much 100% of the tenant base, re-sided 35 buildings, re-landscaped the property, all new staff, new signage. Got the property up to 90% occupancy within about 24 months, and then sold it literally 36 months from the day that we bought it. We bought it for $7.2 million. We were all into it for just under $10 million, and we sold it for $14.5 million.
Wow, that's a sweet deal.
So now we only had a sliver of that. Our investors made about an 80% return on their equity in 3 years, but we did well. But most importantly for us, the reason it's the biggest success for us is because it proved not only to ourselves that we can handle these types of larger transactions, but it proved us within the marketplace. And that transaction led to 3 additional transactions in Charleston within the 18 months following that deal that have been a tremendous success for us and for our investors.
Well, that's great, and that's something that I hear time and time again is after you have had that first favorable experience, that it really does open up doors, and deals do just start to flow at that point, because the brokers as well as the sellers are looking for people that have that experience, that have done successfully. Where did you start to see those deals come from? Were contacts in the area, or were you just looking and you just people were just much more favorable to your responses?
So we became, really intimately familiar with the market during that time period. So it allowed us to kind of get, preliminary heads up on deals that may be coming to market. So we would get prepared 6 months in advance on a deal that was coming out. So when it came out, we knew everything there was to know about this deal inside and out. So we were able to offer on it, present a very well thought out business plan for the sellers to review. We built good rapport with the brokers, and our execution. I mean, everybody knew us because of the deal that we turned around. Like, everybody knew that deal that we bought. So it proved ourselves. And then one of our best deals we ever did, we got from a lender that called us up because they knew that we bought 3 deals in the market, and said they had a client whose dad passed away and they don't want to market the property. And you guys bought 3 other properties in the area, and you got a great reputation. Can I introduce you directly to the heirs of the dad? And I said, absolutely. And we were able to structure a deal, that was very fair, off market. So no one else saw this deal, and it will prove to be one of the best deals we've ever done.
Wow. That's nice. That's really nice. Well, our listeners are mostly, at least our target listening. We have folks from all ages here, but the people that we really target this show to are those that are 50 plus, and some are, looking at their retirement as it's approaching and wondering, gee, am I going to have enough to really do what I want to do in my retirement years, or am I going to be restricted to a fixed pension or Social Security or a combination thereof, and or do I have enough in my IRA and so forth? And there are those that are already in retirement, and they're realizing they don't have the funds that they thought that they would have with inflation and many other factors. And so, what kind of advice would you give to these folks that are in that time frame, that are looking at real estate investing as a means to be able to change their situation around?
Sure. I mean, I would say about 80% of our investors are probably in that category, with my parents being included in that.
Mm-hmm.
My mother loves saying, she goes and has her coffee and, plays her card games. I own this building, I own this building with my son. So I get that. And she loves getting her checks. I think, what's so important first and foremost, because again, this is kind of our demographic that we're talking to right now.
Mm-hmm.
That makes up the majority of our investor base. It's, we try to just instill on them when they're considering an investment, whether it's with us or anyone else, that capital preservation is the most important thing at this phase of their life. And then it's, how can this investment fit in with your overall portfolio and your both near-term and long-term goals? What we offer investors is the opportunity to literally build a portfolio within their, within their overall real estate portfolio inside of their investment portfolio. And it's a lot different than just buying, a REIT or a couple of shares. These are direct investments where they're tax efficient, they get geographic diversity, asset diversity, cash flow, capital appreciation, all of the above. So most of our investors will not come to us and say, hey, I want to buy a building. It's, hey, I like your strategy. I don't want to be overexposed to the overall stock market and, all the basic financial instruments that are out there. I want to allocate 20-30% of my portfolio to real estate and income producing real estate, and not have to own it myself. So what we do is kind of set up a game plan. We show them our different profile deals. And, for a lot of these investors, they're not going to necessarily invest, depending on what situation they're in the vacant deal that we're buying next week. But they're going to invest in the deal that has a progressive value add where there's going to be quarterly or semi-annual distributions, and we're going to build value over time. But again, we cover, now we're in 7 states in 2 different parts of the country between the Southeast and Midwest. Some of our deals are more short-term, long-term. I think for them, they have the ability to build a portfolio. Don't run out at this stage of the game and be a shiny object chaser, I guess would be my advice. Don't go for the home runs, and don't buy yourself a headache. Invest in or invest with, experienced people that are executing a strategy and proven strategy that fits in line with your ultimate goals.
Great.
I think that kind of sums it up.
Yeah, great advice. Great advice. Well, Chris, looking at your current business, what are you really excited about, and where do you see it going in the future?
Sure. I think, the biggest thing that we're excited about, over the last, I'd say year or so now, we've sold 3 deals, bought 3 deals. We're selling another potentially 2 deals. We're buying another one. We're trading up in our business. So, the scalability, I would say, is probably the biggest thing that I'm excited about of our business from where we are now. We worked our tail off to get to $100 million of acquisitions that we just crossed this past December, which was a huge milestone for me from day one, if you remember. Now the next goal is to get to $500 million of acquisitions within the next 5 years. And I think we're seeing, in closing a $21 million deal, you mentioned it earlier, it's just as much work and the same type of work as the $10 million deal, except we're scaling our business 2x on one transaction. And we're elevating the quality of the types of deals that we're doing, which we're very excited about right now. So I'd say for us, we're really excited about the scalability of our business here in the near term. And for where we're going, our goal here in the next 12 to 24 months is to really focus on our investors, delivering them a tremendous experience. We've invested a lot of time and money into our infrastructure, into our technology, allowing investors to literally log on to our investor portal, see the deals we have that are being offered, click through them, see all the materials, watch videos, webinars, and have just a great experience. I've always wanted to take kind of the Wall Street stuffiness approach of commercial real estate out of it and bring it to more Main Street. And, that's where I really see ourselves going. We're going to be launching kind of our own internal crowdfunding portal, essentially. And we want to be able to reach more people and expand our network of investors here in the coming, months. And we're pretty excited for that.
That's great. What a great vision you have for your company. And I can see you doing it too. I mean, you've grown phenomenally in just a relatively short period of time here. That's great. Where do you see the market going? I mean, we've had there's so many economists out there that are saying, the big one is yet to come. And yet we've got like a lot of positive stuff going on in the economy right now. And how are you preparing yourself for whatever may be ahead there?
Absolutely. So, we call that what's the one thing that keeps you up at night question, right? So I think the special thing about multifamily, and listen, all real estate is somewhat cyclical and nothing goes up with a hockey stick curve. We've all learned that over the years. But when you sit down and look at just purely the fundamentals of our asset class, they've never been better. And what that means is we're in a supply and demand game. So demographically driven demand, whether it's, everybody talks about the millennials is easy, right? There's 66 million of them, 18 to 32-year-old, 34-year-olds. Primary, housing is rentals. That's great. You have the baby boomers that are coming out of ownership, coming into rentals. And then you also have, to me, what's really going to keep our industry extremely healthy for the next several decades is now what they're calling Gen Z. And this is the 12-year-old and younger generation in our country, which right now is the same size as the millennial generation. So when the 25-year-olds of today are 35 and buying a house and having a family, the 15-year-olds of today and the 12-year-olds of today are going to be 22 10 years from now. And if you look back over the last 50 years and you look at the national vacancy averages for multifamily, you're not going to see it go over 10% on a national level, because everyone will always need a place to live. So I think fundamentally we're in a very healthy place. I think we've had some artificial inflation of pricing, meaning cap rates have compressed tremendously because a lot of money is out there trying to get into our space. So we're viewing every deal right now with the last question in our underwriting being, if this is a deal we have to hold for the next 10 years, do we want to hold this deal? Do we want to own this deal? And if the answer is not unequivocally, unconditionally, yes, we're comfortable holding this deal for 10 years, then we don't buy the deal. It's that simple. Because I do think there's going to be a normalization because you do have markets like New York, San Fran, DC, Dallas. There's a tremendous amount of supply that's going to be peaking this year. So you're going to start to see things normalize. But you're talking about vacancy rates going from 4.5% to maybe 5.5%. Still unbelievably healthy from a fundamental perspective. So I think we're in a very good place there. I think we'll see steady interest rate increases over the next probably 12 months, maybe a little bit longer. But we're fundamental based. We're not speculative. We are buying deals that we're stress testing and saying, if we can't sell this in 3 years or 5 years, can we hold this deal for the next 10 years? Is it in a location that we want to be in? Is it in a market we want to be in? And is it an asset profile we'd want to be in?
That's great. Thanks for sharing that. Well, we're now definitely we need to wrap it up here, and and with that, we have a series of quick questions that we like to ask our guests, and with a quick reply as best as possible. Are you ready for this?
All right, let's do it. Let's see what we got.
All right, Chris. Favorite real estate book?
Favorite real estate book? Powerhouse Principles, Jorge Perez.
Good. Favorite business book?
The One Thing, Gary Keller.
Most valuable website for success other than your own?
This is a tough one for me. I don't do a ton of web surfing, but I love like entrepreneur.com. I love that stuff. I try to get 20 minutes in the morning, just scouring those for some motivation stuff and tips.
I love it. How about your favorite app on your phone?
Evernote.
Okay. And favorite quote?
Oh, this one's easy for me. Work like there's somebody on the other side working 24 hours a day to take it away from you.
That's a great quote. That's the first time I've heard that. I love it.
Mark Cuban.
Wow. Mark Cuban, great. Okay, so and the final question here is, let's say something happened and you lost absolutely everything, and taking what you already know, let's say you have $1,000 is all you've got in the bank. Knowing what you know, how would you start over to start your real estate investing business?
That's a good question. So I would say master a niche. Become extremely obsessed with one niche, one strategy, and stay the course. Because once you become the expert on that, the money will come. Don't be a shiny object chaser.
That's great. That's great. And finding a niche is not easy. I mean, it's because, like you said, the shiny object syndrome is so easy. You get, well, should I be flipping? Should I buy multi? Should I buy, deeds or liens? I mean, there's so many different things out there. But I think that's true. You once you pick what it is you want to do, sticking to it, making that happen is great.
Real estate is a long game. It's not a short game. This is a marathon sport.
Yeah, definitely. Somebody recently told me, that it's like it's not just one marathon, but you're running 12 at a time, and because you're looking for new properties, you're funding this one, you're selling this one, and I mean it's all going at the same time. You got to finish them all at the same time, so it's pretty crazy. Well, great. Chris, this has been just a fantastic time with you. Thank you for sharing the information that you have. I wanted to ask you, how can folks get a hold of you if they, or your organization to find out more about what you do and what you may have that could interest them?
Sure. Well, I appreciate the opportunity to come on. This has been a lot of fun. I enjoy it. So thank you. People can find us at www.urscapitalpartners.com. I encourage you to kind of get signed up on the site. We do a lot of content that we put out there for free related to all things multifamily. So, whether it's video tours of properties that we're contemplating buying, or blogs, or, just weekly updates on deals that we're doing and have potentially coming up. And the other thing is that we do offer, once people are on our site, is we take a lot of pride in knowing our investors really well and understanding what their goals are, rather than just saying, hey, here's a deal, you want to invest in this. So we offer the upfront, sit down one-on-one, whether it's over the phone conference or if you're local in our office, kind of just talk about, where you're at and where you want to go when it's really, when it comes to investing in real estate and specifically multifamily. So check us out, www.urscapitalpartners.com, and get signed up on our site. And I'd love to speak with you.
Great. Well, we also have a tradition on this show, too, that we are called the Old Dogs REI Network. And just staying true to our name here, we have all of our guests, and no exceptions here, get to give us their best old hound dog howl. Now, I don't know if there's any hound dogs in New York, but there may be, maybe some strays out there. You may be able to pick up some hints here what they sound like. But Chris, we'd really love to hear you howl.
I'm more nervous about this than buying my first deal that I've ever bought. I don't even know how a hound dog sounds, so I'm going to do my best. Arf, arf, arf.
Wow. That was good. That was good for a guy that didn't know. I mean, you must have saw like 101 Dalmatians when you were younger or something. Maybe. Oh, I love it. I love it. Well, Chris, it has been so great having you on. Thank you. And, I think, you're just taking the time out and sharing your expertise is of great value to the folks that are listening. So thanks a lot. And for all those out there, our Old Dog listeners, we appreciate you joining us as well. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us here means a lot to us, and we really appreciate it. Please note, everything that Chris has talked about today will be accessible on our website at olddogsreinetwork.com. And we're pretty comprehensive on our show notes. So we're going to, and every link he's mentioned, everything of that nature will be included in the show notes. So don't worry if you're driving. I hope you didn't try to take notes here. But that information is all available for you. So that's it for today. We want you to remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.